What we need right now is a source for great leads, and I found it. It is called Pipeline Pro Tools. So about 90 days ago, I booked a demo with them. And in that demo, we reverse engineered my business. We figured out how many leads we needed to get in order to get to the closings that we want. And they gave me a playbook to use in order to get that. So I've been using it for 90 days. We've gotten 12 qualified leads, and about half of them are already under contract or closed, which is great. And it is right now my number one source for my best leads that I'm getting. I love this thing. I'm about to ramp up the number of leads that I get with them as well. So, and you might think it's expensive, and it's not. So I was looking for something that's very inexpensive, like affordable to everyone, but also generated great leads. We don't want crap leads. So what you do in order to get this, because I called them and I wanted to partner with them because I was like, this is exactly what our audience has been looking for. So they set up something specific just for us, just for Fight Club listeners. So you would go to pipelineprotools.com/Fight Club. And then you go to the demo, and the demo will show you how many leads you need in order to get the number of closings that you want to get. And then they will give you the playbook that I'm using, my number one playbook for getting leads. And then you can use it too, and we can have happy closings. So go to pipelineprotools.com/Fight Club, book and go to the demo and get all the leads.
All right. I am here with Nathan and Eda Walldorf. Hi guys. How are you?
Hey, good afternoon.
Good. Thank you. I'm glad you could be on. So we're starting this conversation of, as real estate agents, you're making money and you're like, that you should be investing in real estate, but maybe there's so many different ways. And so one of the ways you're going to talk to us about is investing in multifamilies. But give us your spin and tell us about Walldorf Capital Ventures and what you do.
So we kind of got into this business, I don't know, in 2013, we started investing in real estate, looking for some sort of retirement plan.
Yeah. Isn't that weird? Like real estate is like people use it for retirement, but like most realtors don't have a retirement plan.
Yeah. Well, like financial planner told me it's a great way to make money, but not a great way to build wealth.
Right.
As in being a realtor is a great way to make money, but not necessarily build wealth. So,
yeah.
We really wanted to build some sort of plan for retirement. So we started investing. My wife started investing, and I just kind of was hustling, trying to pay the bills. So she built up a great portfolio, and then we heard about multifamily investing as a way to kind of scale up.
Because you were doing more single families?
Yeah, we were doing single family and duplexes and triplexes.
Small multifamily.
Yeah, small multifamily. And so my wife called me from a conference. She was like, I'm going to sign up for this. And
that's how all good ideas start.
Isn't it?
But I just need you to trust me.
Right. Don't worry about it.
Yeah, I was smart that day. And I said, okay.
He was smart that day.
So we started learning about multifamily, and we probably spent, I don't know, more than $100,000 or more, just kind of learning, networking, becoming experts.
It's an education. It's college,
Well, especially if you're going to ask investors. I always thought some rich guy went out and bought an apartment building, but it's really a group of investors. And I don't want to go ask anybody for money unless I know this is going to be a great investment. It's going to bless them, and it's going to bless them. And and so we just kind of have gone from there. Where I never would have thought I would own, or that we would own 200 units, but we own 200 units outside of Dallas, and are raising equity for another 258 units. And we love to bring.
What's your background that you were the one kind of responsible for the acquisition, and what's your role now?
Yeah, do you want to take that?
Our role in ownership. So actually, so we started, like Nathan said, we had our own portfolio, and so we're very familiar with asset management and property management and being a landlord and all the nitty gritty. So we've kind of gone in and done the micro, and then as we have stepped out and have learned and educated ourselves and invested a ton of time, a ton of effort, a ton of money to learn, to network, to get before the right groups of people that are experts, so that we ourselves can become experts. What we've done is, it's a team sport. So we have found incredible partnerships of people with incredible experience and track record. And we have actually built a portfolio ourselves of passive investments before we even jumped into the role where we're actually becoming what you call active or general partners. Okay. And so we actually have nearly 1,700 units that we've invested as passive investors. And that kind of gave us some more education as to what does it look like to be on this side, and to be getting the reports, and to be seeing the plans, and to learn how are they implementing this? How are they finding these properties? How do they decide what to buy, where to buy, how much of it to buy, how to do value add plays,
how to underwrite, part of it. Yeah. So you can figure out what your returns will be.
Yeah. That makes sense. It's a lot of work. It's a lot of work. You have to do market studies. Our business model is based on looking at the market overall. We look at population growth. We look at.
So you're doing all over the US, yes?
Yeah, but we're centering like in the Sun Belt is where we're centering. Like you want to be investing in areas where they're landlord friendly. Mm-hmm. Investing in areas where you're, like Eda said, where your population and jobs are growing, because that means you're going to have tenants.
Yeah. Well, I think too, like, let's back up a little bit. So a lot of people, I mean, you can be a landlord, but a lot of people are like, I don't want to, I don't have the time. It sounds like a headache. Like, I don't want to deal with it. Right. Or those of us that have done it, we also think that we're like, this is terrible. Like, these people are crazy, or you've kind of capped out. You're like, I have enough that I manage on my own, but I still want to like investing in real estate is still like a great wealth builder. And that's why you guys created this venture, right? So tell us, like, get into like, what exactly is it? So people can invest, like, how does it kind of work basically?
Yeah.
Well, so how does it work? I don't know.
So people like invest, like you have,
So we basically what we do is we kind of book a call with people the first time so they can get to know us and we get to know them and see if it's going to be a good fit for them. And then, I mean, we teach them all about how to evaluate, just kind of invest in a knowledgeable manner and how to get started. And then we present them with an opportunity a lot of times. So say we've got that 258 unit deal that we're raising equity for, and we say, well, here it is. Here's what your returns are going to be. Here's the 2x, or the equity multiple at the end and the tax savings you get. And then if they want to invest, they fill out some documentation that makes it legal. That basically is saying you own X shares in an apartment building.
Okay.
And then they get returns along the way. And then at sale, they get the biggest return.
So what? Yeah, right. Exactly. Then they need to 1031 it into something else. But I guess that's a different.
Yeah, but it's doable.
Yeah, that's doable.
It's doable.
Well, one of the things I guess the benefits of this type of investment is that you can multiply your money, you can leverage your money without you having to work for it. You can put your money to work for you without having to do the work yourself.
Right.
3 ways. And one of the 3 ways that you do is say, usually there's a minimum investment. So it's somewhere between $50,000 to $75,000 that somebody can come and put the money in. And then there are 2 types of syndications: accredited investors and sophisticated investors. So the accredited investors are the ones that, and you'd have to check with your CPA and verify the rules according to SEC. But, it's generally somebody has made 200,000 in 2 consecutive years or more and expects the same as a single person, or 300 jointly, or has net worth of $1 million, exceeding $1 million. And then a sophisticated investor is somebody who has kind of educate themselves on the risks of investing in real estate, understands that, it's not a safe bet, like anything can happen. There are always risks.
Or at least it has risk.
Right. Yeah. Exactly.
Yeah. But it's one of the safest, as ways to hedge your funds against inflation.
Right.
It's secured by a tangible asset and all that good stuff. So anyway, people put their money in, they sign, like Nathan was saying, they sign a document where they essentially become a partner or a part owner of this entity that owns a building.
Yep. So without having to manage it, but they're still like able to make returns.
Okay. Yeah, we run the business and they just sit back and relax.
But you have a property manager too, right?
Absolutely.
Yeah, I mean, that's part of the great thing about scaling up, is if you've got 100 units or more, it really makes sense to have a property manager.
Well, even on a small scale too, it's like, it doesn't make sense to just own like one building, right? Like if you're starting this business, you have to be ready for like 5 or 10. But then once you get to 5 or 10, it's like, okay, well, what now? Right. And this is like a good next step where you're still investing in what you know, but you don't have to like be there.
And the nice thing that I love about this asset class compared to like your duplexes and triplexes is it's more based on your net operating income, on what your value is based on what the property makes.
Yes.
Based on, we've had duplexes and
well, it's less saleable too. I mean,
duplexes and triplexes, they still compare it to other properties despite the value, despite the fact that it makes more money than those other properties.
Right.
And so I find the evaluation is much better, and rents never go down. Honestly.
Oh, and most people just couldn't go out and buy like a 230 unit property. So this is like a great way, but they do, like you're saying, they make more money. They're more profitable. They have more profit upside, right? So it's like, this is a good way to have that investment without like or else you wouldn't be able to do it.
Yeah. And can I show you, I'd love to show this calculator trick because it gives a little idea of just the power of exponential real estate investing when you're multiplying the numbers.
Yeah, do it.
Basically, like when you buy a duplex and you have one tenant that moves out, there goes half your income.
Exactly.
Same with a quad, a fourth of your income is gone.
Right.
That doesn't affect.
That math is too complicated for realtors. Eda.
Yeah.
No,
This is real easy math.
Yeah. Too complicated. No.
Let's picture, the way like Nathan was saying, the valuation, it's not like it in our regular world residential real estate where an appraiser comes in and he says, well, that house sold for this and this house sold for that. So yours, I'm going to say it's going to be worth this, and it can kill a deal, right?
Right.
That's not the way this business works. It's solely based on the returns, on the math.
Okay.
So it's pretty like foolproof.
Yeah.
So let's say you have a building that's worth that has 200 units. Okay. And let's just make it really simple. And let's say that the 200 units are renting for $1,000 a month.
Okay.
So 200 times,
Is that 2 million? Is it $2 million?
No.
Okay. So 200,000 a month.
Yeah.
And then we're going to take 12 months.
Yeah.
So that's $2,400,000 a year.
Mm-hmm.
Okay. So let's take out expenses. So let's divide it by 2. And so let's say that NOI, which is a net operating income. I mean, that's a shortcut.
Well, and a 50% expenses seems pretty high, right?
It is.
And those rents are low. So this is a really conservative example.
Very conservative example.
It's conservative, but at the same time, it's an apartment building.
Yeah.
So there's a lot to maintain.
So let's just say that's our yearly NOI, net operating income. Okay. And the way that somebody comes and evaluates how much is this building worth, what would it sell for in fair market value, is you divide it by the cap rate. Now the cap rate is a measurement established by the market that tells you how much you would get for your investment if you paid for it in cash.
Okay.
So different markets have different cap rates. Right now, they're very compressed.
Yeah.
Because there's so much demand. They're kind of low. So let's just, as an example, assume that this particular building is a cap rate of 3%. Okay. So
that's terrible.
Yeah. So
it is. But then there's Really,
That's if you pay for it cash.
Yeah, you're making money on your cash on cash.
Yeah.
You know,
Okay.
So that building would be worth $40 million.
Wow.
Okay.
Okay.
So 200 units, $1,000 a month. Now, the way that things are going right now, think, organically, you could probably raise rents $200 and you would kind of be playing catch up without even like doing any CapEx budget renovations. Okay.
Right.
So let's just assume that we're just going to raise $200 of rent on those 200 units, 40,000 a month times 12. That's 480,000 a year, and we're not going to take out any expenses because it's just this organic.
Yeah, gotcha. Right.
And so we're going to divide this by the 3% cap rate to see what kind of value that would add, and that's $16 million.
Wow, that's crazy
value.
Yeah.
So now we're at $56 million asset just because we were able to organically raise.
Well, and to your point, it's like when you, as an investor, when you only have a few doors, right? Like you're saying, let's call it $100,000 or 50. You said it's like 50,000 to 75. You're saying $50,000. You can put a down payment on, we'll call it maybe even a 4-family. Okay. But if you could take your 50,000, you put it on 200 and you're with other people, it's like what you're showing there is you can exponentially make more because there's more opportunity, there's more doors,
and there's a safeguard,
yeah, it's safer, right? A lot safer. I like it.
And you don't have to move a finger,
Hey.
So
well, you got to press enter on the transfer.
Yeah, you're right, that finger does need to click. But there are 3 ways, like I was telling you, there are 3 ways to make money once you put your money into this investment. The first way is you get a cash on cash return, and it's usually an annualized average of 6, 7, 8%, depending on which building.
Yeah,
so that's pretty healthy return.
Yeah, I mean that's what we're making, returns we're making on what we have. Yeah,
exactly. Then the second,
but I have to do a lot more work.
Exactly. Then the second thing, we call it a trifecta, right? Because there are 3 ways to make money. So the cash on cash. The second thing is you get usually somewhere between 1.4 to 2 times, sometimes 3 times return on your investment. So to make it really simple, let's say you put 100,000 in. By the time of the end of the hold period, which is anywhere from 3 to 5 years, depending again on the business plan, you'll pull out 200,000.
Oh, so it's almost like a CD. So the investment's only held up for around 3 to 5 years.
Yeah, and it depends on the business
We've
plan.
been on one where it was 10 years.
Yeah,
but,
it just depends, right? Okay.
Yeah. So the first way, the 7%, let's just say 7%. The second way is you get 2x your money. And the third way, which is one of the really exciting ways, in my opinion, because people don't equate tax savings with earnings, but it's huge because we do what it's called a cost segregation study. Okay. And you know how when you buy a house, you depreciate it over 27.5 years?
Yeah.
If you're renting it.
If you're an investment. Well, with these assets, we can do what's called bonus depreciation.
Oh,
we can depreciate it in 1 year.
1 year?
1 year. And so then most of the times with the models that we use, we can get people 80 to 100% tax write-off on the full amount that they invested. Of course, they'd have to consult their CPA
to see if that's right.
But that's the general rule. So like we just got a K1 a few weeks ago from our investment from last year, and that one was nearly 90%. So we put in, let's say we put in 100,000. Well, we got a K1 saying these people don't have to pay taxes on 90,000.
90% just on the 10,000. Yeah, that's great. That's
amazing. Awesome. So that's money in your pocket. I mean, where else can you do that and not move a finger except for the signature finger?
Nowhere. I don't think you can. Yeah. I mean, I think that's good. That's like that's what we're trying to do is open up conversations about creating your nest egg, creating your retirement. There's a lot of ways to invest. And as real estate agents, we should be investing in real estate, but not everybody wants to do a fix and flip. Not everybody wants to be a landlord. And this is like a great alternative, I think.
Oh, it's amazing.
Yeah, it really is. And I mean, the folks who invest in this are like Wall Street firms, and insurance companies love to buy apartment buildings because really safe place to park their money and grow their money. So they get both out of it.
Exactly.
I mean, it's a wonderful investment. And honestly, when the markets don't do as well, multifamily actually does very well. Right now, multifamily's grown a lot. Like
rents are so high. And I think I think actually multifamily and apartments, like pretty much everything's going to be towards that because we have to have higher density in where we're at. And that makes it an apartment, right? And it's,
that, and honestly, home ownership, as we all know, just being
expensive.
It's getting to be a more elusive thing for the regular American.
Yeah.
And, less and less people are able to own, and they end up having to rent. Because
even though rent is high.
Even when rent is high, you have to have a place to live. So it's more job security for the multifamily asset.
Yeah, agreed. Well, if people want to learn more, or they do want to invest, like what is the best way to get in contact with you?
So we're offering the Real Estate Fight Club listeners. They can book a call with us. If you go to Walldorf, it's spelled WALLDORF, capitalventures.com/invest. Then they can schedule a call with us, kind of hear more about how to invest in multifamily, and we'd be happy to tell them about our latest investment as well.
That's awesome.
Yeah.
That's cool. Are you guys also looking if they know of an investment that could be?
Sure.
Absolutely.
If it's in a landlord friendly market.
Tell us what market is not landlord friendly.
Well, California is not the most landlord friendly in the world.
What's one of the most landlord friendly? You said in the Sun Belt, like what's one of your favorite places to invest?
Like we love Tennessee, Texas, Florida.
Tennessee's good because of the taxes.
Yeah, we're in Tennessee.
Yeah.
And so that's why so many people have flocked. Those have been the 3 growth states, really, because people are flocking from the north
and the Carolinas. The
Carolinas are good. Yeah, those are awesome. All right. Well, I really appreciate you guys being on. Thank you so much for sharing your knowledge.
Thank you, Jennifer. It's a pleasure to be with you this afternoon. We appreciate it.
Have a good one. Why do 85% of real estate agents get out of the business in less than 3 years? Well, the main factor is that these agents don't realize that they own their own business. So my coach, Coach John Kitchens, has put together a free clarity report for us. This is whether you want to earn $100,000 this year or $1 million. This report will give you the clarity you need to thrive in your business and not be a statistic. Go to coachcodeclarity.com for your free clarity report outlining what your success looks like. If you like this content, don't forget to hit the like and subscribe button so you won't miss a thing.